environment. Happy to have right now Erin Gibbs with us, the Main Street Asset Management CIO, Mitch Rochelle, Macro Trends Advisors, LLC founding partner. Welcome to both of you. And we had to move things down with this former President Trump financial news. But first off, Erin, on the financial news here, to most Americans, the cost of borrowing goes up because the price of everything keeps going up. Now the question is how much and how long?
Right. And so we're looking at one of the things that I'm sure will be part of the press conference is what's the termination rate, meaning just how high is the Fed going to keep raising rates before they finally start bringing it down? And then also how many times do they think they're going to raise rates? Is this going to continue for another 6 months, another 3 hikes, so on? So those are the details that Wall Street and even, just everyday consumers should be worried about or concerned, particularly when it comes to your borrowing rates and how far is this inflationary going? How far is inflation going to really take you?
They started this, in March, right?
Yep.
Has there been any measurable impact on inflation since that? What is the delay effect? What do you look at?
I don't think there's been a big move in inflation. I think the most important thing in inflation has been energy costs, whether it be fuel costs at the pump. We've had, 99 consecutive days of the gallon of gas going down, and today it went up. But it's the way that energy costs and food costs sort of trickle through everything else in the inflation basket.
So there's always the risk that in the middle of what you're doing, you could overdo it.
Right.
Absolutely.
Do you think?
Well, I think that's actually somewhat happened. Look, we can't call it a recession, apparently, but we've had 2 consecutive quarters of negative GDP growth. So to the question you asked, Aaron, what I'm looking for Powell to talk about is if the economy continues to slow down as a result of this approach of raising rates, where are they going to pivot, and do they pivot? And I think that that's probably what the press pool wants to know, because we could find ourselves in a 3rd consecutive quarter of negative GDP growth, which is what they're trying to accomplish. But what's the ramifications of that, over time?
Now, they're also going to announce what they're doing or spell out in more detail tapering, right? Unloading all these Treasury securities, mortgage-backed securities, everything that they've been scarfing up over the last decade, right? And
yes.
Selling it en masse or not letting them, renew. That could be more of an impact than any rate rise, right?
Right, because what it means is that there's going to be more bonds out there. I know tapering sounds like we're doing less, but it actually means there's a lot more, which means that the bond prices will go down because there's more bonds and less buyers, or they're going to be at cheaper prices, which means rates go even higher.
Fewer, right?
Exactly. And
that will drive up rates still more.
Exactly. That also creates volatility, because if you have lots of bonds that aren't being bought, prices can move quite around a lot. That means rates get volatile, and that means that the stock market gets volatile. So there's just, yes, even more so. So there are just a lot of impacts when it comes to adding a lot of bonds in a period where we're not really sure that the buyers are out there.
It's interesting, Mitch, and all this. I know real estate is a particular strength of yours, but existing home sales down in this latest period, 7th straight month, maybe not as bad as we thought. Mortgage applications actually ticked up a little bit in the latest week, but they're still relatively soft. Where are we on housing right now?
First of all, I have been pretty vocal on this network that the housing crash isn't happening, and stop waving the caution flag as hard as people have been. So I've argued with many.
What should worry is I agree. So you should run the other way.
Yeah, but I think what's important to recognize about housing in today's number of existing home sales, it's not necessarily the way that a home sale impacts the economy from that sale transaction. It's more when people buy a house, they put stuff in it. And we have to remember that our economy is driven by the consumer, and personal consumption is 2/3, 3/4 of the economy, depending on the quarter. And if people aren't buying homes, that means you're not buying stuff for their homes. And that's the real knock-on effect. One other thing I'll say about housing is rents are going up like crazy. So even though it may seem to be incongruous that in a period of rising interest rates, people are perhaps going to run away from buying homes. But if rent's going up at a faster pace than interest rates, and that's your only other alternative, I think people are going to stay in the home purchasing market.
Even in the hot markets, Florida quite well. Do you see any signs there that it's finally kind of running out of breath?
I will recuse myself from talking about the sale of my in-laws' home, which fell through over the weekend. I'm not going to talk about that. Maybe I just did. But, listen, listen, you can't ignore. I brought this because of you, Neil. By the way, because you and I always talk about people living in Florida. That great migration of
They
Florida.
talk about on the cover of the New York Post, the Great Escape. A lot of people leaving high tax, high crime New York for the sunnier skies of Florida, but it's alive and well.
It's alive and well. It's alive and well. It may not be as hot, metaphorically speaking, but the fact.
See what you did there.
Yeah, I'm that good, Neil. But the fact of the matter is, it's still pretty warm.
Aaron, what is the basic view you have of the economy these days? You know, you always hear, and to Mitch's point, people are bummed out, depressed, housing's going to crash. My 401k is a 10K. You know, and is it that dire? How do you sort of see things going?
Well, no, it's not that dire. Otherwise, we wouldn't have the Fed keep raising rates, right? Because we do have unemployment still at very low, relative lows. We still have more jobs than people looking for jobs, and we still have wages going up, though obviously not as fast as inflation. So that's the reason that the Fed believes that they have this cushion to raise rates so much, and particularly by 0.75%. Yes, certainly the wealth effect. If you're looking at your 401k, that does make you feel like you want to spend less, which is actually what we want to do. We would like the consumer to spend a little less to get the inflation down. But overall, we're still in a pretty stable position with positive outlooks for the next year.
All right, fingers crossed. Don't wander too far. I don't want to pick your fine brains again here.